Welcome Band 5902 students to this online lesson. This lesson will give you a brief introduction to electronic banking. Electronic banking is addressed in topic 3 of your course material. As you can see from the slide, electronic banking involves a whole range of transactions and banking activities by which the transaction or activity is initiated and often completed electronically. Although the original instruction, for example, to transfer a certain amount of money from one account to another may be paper-based and signed by the bank's customer, the interbank communication and the execution of the instruction is by electronic means. It is important to note that electronic banking, where it concerns the aspect of payment, and in particular electronic payments, is really just another method of effecting payment. There's a lot of excitement around new electronic methods of payment and also cryptocurrencies and blockchain, but ultimately they are another method of payment with the outcome of transferring economic value. Now let's look at electronic fund transfers, or EFTs in particular. An EFT is an example of one of the many banking activities which can be lumped together under the term electronic banking. It is also one of the most popular methods of payment in modern banking law. It is important to emphasize that the field of electronic banking, and specifically that of electronic fund transfers, is a vast area of banking law. What we present here today is merely introduction to and a small sample of the concepts and potential legal problems encountered in this area of law. We will now consider a general overview of electronic fund transfers. Let's look at the first point on the slide. An electronic fund transfer can be described as a fund transfer that is made largely or only using electronic methods. There is, however, no universally accepted legal definition of an EFT. It can also be broadly defined as a transfer of funds in which one or more of the steps in the payment process that were previously done by paper-based techniques are now done by electronic techniques. We will now move on to the second point on the slide. Electronic fund transfers include all payment instructions that are transmitted through magnetic material. Examples of these are such as magnetic tapes, discs or cassettes, or through purely electronic media such as telephones, or by the use of electronic transmissions between computers or between a computer and a terminal. The third point on the slide reads, these transmissions are used to effect a wide range of electronic fund transfers involving devices and platforms. Examples of this is such as automatic telemachines or ATMs, mobile banking, home banking, video banking and office banking, and internet banking. Further, on the fourth point, clearing process of electronic fund transfers pose certain inherent risks to the originator, who is usually the customer of the bank. Now, although an electronic fund transfer is a very quick, popular and convenient method of payment, the clearing process of electronic fund transfers pose certain inherent risks to the originator, who is usually the customer of the bank. One of these risks is the clearing process of electronic fund transfers. Electronic transfers in general are processed and cleared on the basis of an account number only. The instruction to the transfer funds from a payment card or electronic purse is executed without matching the name of the designated payee with that of the designated account number to which the payer wishes to transfer or effect payment. For this reason alone, it is highly beneficial for banks if their clients make payment by means of an electronic funds transfer, as this places far fewer responsibilities on the bank compared to other traditional methods of payment, and therefore this reduces the possibility of the bank acting negligently. On the final point, South Africa has not enacted any legislation dealing specifically with electronic fund transfers. In the absence of such specific legislation, the legal relationships between the parties involved in EFTs are regulated by the general principles of the law of contract, including the express and/or implied terms of the agreement, as well as certain provisions of other more general acts such as the Electronic Communications and Transactions Act 25 of 2002. We will now look at the payment by electronic funds transfer. Payment by EFT usually involves two basic steps. Firstly, the payment instruction is given by the person who wishes to make payment or who wishes to accept payment to the financial institution which is holding the funds. Secondly, the financial institution will transfer the funds to the account of the beneficiary at the same or another financial institution. The underlying principles remain the same, regardless whether the procedure is paper-based or electronic in nature. With payment by EFT, the payment instruction is given and executed through electronic communication means. In its simplest form, an EFT is therefore just like a check, an instruction by the customer to the bank to transfer the money to another account or the beneficiary. The only difference is that the EFT transfer instruction is given by means of electronic communication. As in the case with payment by check, the bank which receives the instruction from its customer to effect an EFT acts as mandatory of the customer. The legal relationship between a bank and its customer who wishes to make an EFT will thus be governed by the contract of mandate. The transfer is executed by a series of mandates which eventually results in the crediting of the beneficiary's account and the debiting of the originator's account. Payment by EFT therefore involves the adjustment of balances on the bank accounts of the payer and the payee. The beneficiary accepts that the payment will, in terms of the transaction underlying the electronic funds transfer, be paid to him or her by the originator's bank. Payment by means of EFT is therefore an absolute and not a conditional form of payment. An electronic funds transfer is not an instrument of payment, but rather a method of payment, and it does not constitute legal tender. Electronic fund transfers can be divided into two groups, credit transfers and debit transfers. In the case of a credit transfer, the party who wants to make the payment instructs his or her bank to transfer the funds to the account of the beneficiary. An example of a credit transfer is when transfers are made through the direct payment of salaries by using the Automated Clearing Bureau, or known as ACB. The ACB is a company established in 1972 by banks to provide computerized facilities between banks. In the case of a debit transfer, the person to whom the payment must be made claims the money from the financial institution which holds the debtor's account. Making this payment can either involve only one bank, where the third party and the payer bank with the same bank, or more than one bank. Where more than one bank is involved, it would require an interbank transfer. An example of a debit transfer is payment by way of electronic funds transfer at point of sale, or known as EFTPOS. We will now continue to the next slide, which will explain EFT systems. Electronic fund systems can broadly be defined into two systems. Firstly, the one type of electronic fund transfer system is those which are activated by banks. The system is activated by banks to facilitate electronic fund transfers between banks and to send financial messages. Although clearinghouses, such as ACB in South Africa, are primarily used to bring about settlement between banks, they are also used to effect electronic fund transfers between banks. Secondly, there are customer-activated systems. This involves different electronic fund transfer systems that are activated by customers. These are, for example, automated teller machines, or known as ATMs, electronic fund transfers at point of sale, EFTPOS, internet banking, mobile cellular phone banking and telephone banking, and lastly, electronic money. We will now discuss customer-activated systems in more detail by discussing each listed in the next slide. We will now expand by discussing customer-activated EFT systems. Firstly, the automated teller machines or ATMs. An ATM can be described as an electronic vault that enables the user to withdraw or deposit money or obtain other banking services. An ATM functions as a method of payment only in the case of a transfer of funds. The second type of customer-activated EFT system, the electronic funds transfer at point of sale, or known as EFTPOS, will in particular be dealt with in detail for purposes of this lesson. The EFTPOS payment system is utilized in conjunction with a debit or a credit card and is founded on mandate as the customer instructs his bank electronically to effect payment. Let's consider the question of what are the steps or processes in a typical EFTPOS transaction. In a typical EFTPOS transaction, the customer uses a terminal connected to a merchant's cash register and pays electronically for goods purchased from the merchant. The magnetic stripe or smart card chip on the back of the customer's credit or debit card is swiped through a reader held at the cashier's register. The customer chooses the account to be debited by typing in the correct number on a keypad. The merchant then keys in the value of the transaction and the customer keys in his or her PIN. The particulars of the transaction are then transmitted by the merchant's financial institution or switch network to the cardholder's financial institution. The PIN and the particulars of the customer's account and account balance are checked in order to determine whether there are sufficient funds. If the transaction is accepted, the amount will be debited against the customer's account and credited to the merchant's account. An EFTPOS transaction is, therefore, essentially a debit transfer. The bank is authorized to effect payment by the customer swiping the card and keying in the PIN number, whereafter it will no longer be possible to countermand payment. Since the bank acts as mandatory, it has to act with diligence and skill in the exercise of its mandate. Although the typical EFTPOS transaction means that the PIN is used for authorization, there are EFTPOS systems that require handwritten signatures. The customer's card is swiped through a reader and duplicate transaction slips or sale records are issued, which must be signed by the customer. The signature of the customer identifies him or her and also gives authorization to the bank to pay. A copy of the transaction slip is kept by the merchant and handed to the bank should a dispute arise. The other copy is handed to the customer for his or her own records. Now let's consider the last question, whether there is any difference if a cardholder uses a credit or debit card. It is irrelevant whether a customer uses a debit or credit card to make payment. The customer decides from which account he or she wishes to transfer the money to the merchant's account. If the customer's credit card account is debited, the customer has the advantage of revolving credit. The customer will pay in the usual way when he or she receives the credit card statement at the end of the month. However, if the customer indicates that he or she wishes to debit the check account, the account, if the system is online, will be debited immediately. We will now move on to discuss the legal relationship between the participating parties of an EFTPOS system. There are at least 3 interdependent contracts involved in case of a EFTPOS payment where only one bank participates in the system. The first contract is between the customer and the merchant. The second contract is between the customer, who's the EFTPOS card holder, and his or her bank. The third contract is between the merchant and the bank. We will now discuss the first contract, which is between the customer and the merchant. There are 2 elements to this contract. There is the element of sale of an item, but equally important element is that the merchant will accept a properly validated EFTPOS card as payment of the customer's obligation. This second element is implied from the presence of an EFTPOS card reader at the pay point of the merchant, and also a sign that indicates that EFTPOS payment is accepted as a method of payment. Now let's discuss the second contract, which is between the customer and his or her bank. This relationship is governed by the terms and conditions entered into when the bank issued the card to the customer. Before issuing a card with EFTPOS capabilities, banks always require the customer to sign a form agreeing to their standard terms and conditions. The precise details of these contracts vary from bank to bank, but there is a common theme of matters dealt with in the standard terms. The most important standard term, as far as the customer is concerned, is defining the circumstances under which the bank is entitled to debit its customer's account. The general rule is that the customer is liable, at least initially, for all uses made of the card or PIN, whether authorized by him or her or not. In some cases, liability for unauthorized transactions is limited in the terms of the contract. For example, by informing the bank of the loss of the card or PIN. A second term that is standard to all card conditions is the customer's obligation to keep the PIN secret. A third important standard term is that the EFTPOS transaction is irrevocable. An EFTPOS transaction can therefore not be reversed if the customer decides to return the groceries to the grocer, because, for example, the goods are damaged or of poor quality. Instead, the customer has to take recourse against the grocer directly and claim the money back from the grocer. Now let's discuss the third contract, which is between the merchant and the bank. This contract will also regulate EFTPOS as a method of payment. This contract will be the standard commercial bank account contract, but as with a customer's contract with a bank, it will contain particular terms relating to EFTPOS payments. Important terms in the contract between the merchant and the bank relate to the time at which the merchant's bank's account will be credited with a relevant amount and the procedures dealing with erroneous and unauthorized payments. There are different consequences for the parties depending on whether the EFTPOS transaction took place in an online or an offline system. We will now discuss the online and offline systems relevant to EFTPOS transactions on the next slide. We will now discuss online and offline systems relevant to EFTPOS transactions. On this slide, we will particularly discuss online systems. So an EFTPOS can operate either in an online or offline system, and depending on which system is utilized at that time, it will influence the legal nature of the transaction. With an online system, the money is electronically transferred directly from the cardholder's account to the merchant's account. When the system is online, the payment instructions are transmitted directly and debiting and crediting takes place immediately. If the bank accepts the payment instruction, the bank makes payment not relying on the undertaking, as in the case of an offline system. The bank makes payment as the customer's mandatory. Further, in the online system, the possible contractual liability of the merchant towards the bank is limited. The EFTPOS terminals used by the merchant are usually the property of the bank. The merchant usually undertakes to keep the terminals in a good condition, and the merchant may therefore be held liable if the terminals are in a bad condition. The merchant also undertakes to use the hardware and software provided by the bank. We will now look at the general legal consequences attached to an online EFTPOS payment. Where the EFTPOS payment takes place in an online system, the payment is similar to using cash. The sales agreement will be completed between the customer and merchant as soon as the debiting and crediting of the different accounts takes place. Where the payment was not completed for whatever reason, the customer must pay using another method to avoid cancellation of the sale agreement. We will now discuss the offline system in the next slide. In an offline system, the payment instructions are stored on a magnetic tape or disk for processing at a later stage. Thus, the transfer is delayed. In some systems, a delay of a few days, usually 3, is built in, so that customers' accounts are not debited immediately. In an offline system, there is a risk that the customer makes a purchase that exceeds the credit limit at the bank, as the merchant is not able to ascertain whether the cardholder has sufficient funds to pay the merchant. In this instance, the merchant is authorized to accept EFTPOS up to a specific amount. By implication, then, the bank agrees to pay any amounts as long as the specific amount is not exceeded. Where a purchase price is above this specific amount, the bank needs to first authorize it first. We will now look at the general legal consequences attached to an offline EFTPOS payment. In an offline system, the bank undertakes to pay provided that the merchant stays within the prearranged limit. There is thus a third party, the bank, who also undertakes a payment obligation towards the merchant. Given this, it may be argued that the cardholder, who uses an EFTPOS where the financial institution undertakes to pay the merchant, obtains ownership with delivery, although real payment is effected at a later stage. So although payment is delayed, the transaction is considered a cash transaction because as a rule the party's intention will be to conclude a cash sale and not a credit sale. Further, other general legal consequences attached to an offline EFTPOS payment are: in an offline system, the bank will also not pay the merchant where the merchant did not comply with security procedures. For example, where a signature is required and failed to check the cardholder's signature, or the list for blacklisted or stolen or lost cards. An offline EFTPOS transaction does not constitute a novation of the cardholder's obligation, and the merchant may still claim from the cardholder if the bank does not pay. To explain, let's consider what novation means. Novation will occur when the creditor, the merchant, obtains a new personal right against a third party, the financial institution, in place of the existing personal right against the customer, which is thereby extinguished. Now, where the novation has taken place will depend on the intention of the parties, which is deduced from the facts. The intention in an offline transaction most surely is that the merchant obtains a personal right against the financial institution to make payment to the merchant, and the customer will not be liable to make payment to the merchant. However, where the financial institution fails to make payment, the customer will still be liable to pay. Smart card technology has the advantage of allowing for offline authorizations when transactions are processed, as it authorizes its own transactions. A smart card is a plastic card embedded with a microchip which enables it to store a large amount of data and to process information. When used in an offline transaction, it does not need to connect to a mainframe computer, so it is not exposed to computer network failure. We have now concluded our discussion regarding the EFTPOS system. This was our most comprehensive discussion listed under Customer Activated Systems, as the other items, specifically item 3 and 4, will be discussed in more detail in other lessons to follow. So to recap, we are now on the third item of Customer Activated Systems: Internet banking, mobile cellular phone banking, and telephone banking. Internet banking or mobile banking enables a customer to make use of several financial services in a convenient manner. Using these electronic banking services, the customer can check balances, ask for provisional statements, transfer funds between accounts, pay creditors, and check bank account statements. Even though this is the most convenient payment method, it does come with some risks. In the agreements that banks sign with their customers, they attempt to contract out of liability for any loss the customer suffers as a result of using electronic banking. However, it will depend on a case-to-case basis whether the provisions of the agreements can withstand constitutional muster. We will now move on to the final example of customer-activated systems, and that is electronic money. Electronic money, or e-money, is defined as monetary value represented by a claim on the issuer. This money is stored electronically and issued on receipt of funds, is generally accepted as a means of payment by persons other than the issuer, and is redeemable for physical cash or a deposit into a bank account on demand. The South African Reserve Bank published its final position paper on e-money in 2009. The concept of e-money includes e-money cards, which is electronic purses, digital cash, which is prepaid software products for use on the internet, and mobile money, known as m-money. Products that enable consumers to use conventional payment systems such as payment by credit card on the internet are excluded. This brings us to the end of today's lesson. The next lesson will deal with selected aspects of electronic banking. The purpose of this lesson was to give you an introductory overview of electronic banking. However, please do study your prescribed reading materials relevant to electronic banking in detail. We wish you well with your studies.